welcome to the Not podcast, which is CompStak's podcast. And happy to be hosting another episode with LD from Cherre. LD and I have known each other for a long time, so this will be fun. And we're going to talk about AI, which I was not excited to talk about AI because every podcast that anybody asks me to do or any event, it's always about AI. And I'm like, I'm kind of over talking about AI, but I'm not over talking about AI with LD because it's more fun and it's more interesting than a typical AI conversation. So I think this is going to be interesting.
We're not going to make it bullshit?
Well, no, we're 100% going to make it bullshit.
Sure.
Yeah, absolutely.
Just want to make sure.
Yeah, no, definitely a lot of bullshit. But why don't you tell everybody who you are, and then we'll dig in.
So thanks for having me. I'm LD. I'm one of the founders at Cherre. We're a data management analytics company specifically designed for the built world. So we help our clients, large asset managers, banks, insurance companies, connect all their disparate data, whether it's internal financial operational data or third-party market data, such as CompStak, into a single source of truth in a repeatable, reliable, consistent, accurate manner. Then deliver that downstream either back in the same applications it came from, into their existing data warehouses, or very often today into BI and AI type tools, so to be able to make better decisions around either at the asset management side, what do I own, where do I own it, how is it performing versus budget, underwriting peers, things like that. Or on the investment side or underwriting side, again, it could be insurance, it could be debt, mortgage, it could be equity, trying to understand markets, sub-markets, opportunities better than my peers, including my internal data, be able to make more informed decisions. So that's kind of us.
Awesome. Cool. Well, I'm going to jump right into this. And let's talk about real estate investment with AI. And when I say real estate investment with AI, I mean like models, machines making real estate investment decisions. Is that a thing? How far away from it do you think we are? And do you see that happening?
Is that a thing now? No, for sure. I know some companies will say that they do that for sure. Some of their clients, I'm not going to mention names and shit on them too much, but very much the case that some people will claim to do that. It's a lot harder thing to do than it sounds, right? So if I have to break down the problem, there's, I've said this a lot. I think that humans begin where the models end, right? Or where the uncertainty kind of ends. And I think that in our industry, the information that we have, let's say a broker gives us all the information on a deal, right? Mm-hmm. You and I have the exact same information about that deal. And you'd say, well, let's go buy some data vendors. Well, we'll all buy CompStak. We'll all buy, CoStar, TREP, RC. So we're all buying the exact same data sets. And our internal data might be of value if we're really big. If I'm a Brookfield or a Starwood or a Blackstone, I have a pretty big data set, but even those firms, it's not necessarily as connected and easy to access. Right? It might be siloed across the organization. But even if it's all connected, those big folks might have an advantage. But the vast majority of the market, I have one office building, two office buildings in the region. What can I glean for that except maybe saying that, the teaser's bullshit, right? I can maybe call them like that doesn't make any sense. But now we're just competing on price, right? Or who can get, maybe if you trust me, I'm a faster speed to market, right? There's no room for a model to help me in that process where it's broker driven, right? So where would a model make sense? I mean, there's like the JLL Horizon model, so the old Skyline team.
Yeah.
I think that they're trying. One of the things that the Skyline model I think did well. I actually don't know that this is a fact. I know that this was what was claimed, so I'm going to take them at their word because they're pretty honest people. Which is, it did a good job in finding an asset that was off market, but it's likely going to sell or need to sell. Meaning. And again, it's not really complicated information, but I have to take in what's the term on the debt, what's the likelihood it's going to have to be refinanced, what's the hold period on average, is this some macro features that around the area are secular trends supportive of that, right? And then maybe at the end I might say, well, here's a list of assets that are more likely to trade, and maybe that I can also back that and say, well, when I said that we're going to trade, we're a higher percent of those over time than what maybe the market would have predicted trade.
Sure.
But even if I did that, and again, I'm not trying to belittle those models or those people, but what does that mean? It means that I now can go to the asset that's off market and give them a call. The broker's doing that, right? That's what the broker's doing all day long, trying to close a deal and get somebody to. So how much of a difference is that going to make? I mean, I don't know. It's hard for me to answer that. And I think about Blackstone, which has a pretty formidable data science team. It's not this real estate building models like that data science team. It's when a transaction happens. We're about to buy, Tricon. Like we're about to buy 3,000 SFR units. Let's have the data science team analyze this and see if, there's some risk there that we're not identifying or opportunity we're not identifying. But it's very transactional, right? So I'm a little skeptical, maybe to jump to the end, I'm a little skeptical that this kind of, this world of, models being very, very valuable. But I don't want to sound super negative about the future because I think we're coming to a point where if it's in fact the case, like I said, I think it's true, but somebody might challenge me, that the vast majority of the data is commoditized to a certain degree. And that at a certain scale, I can just buy all the data and then let's say I'm connecting all my data through Cherre. So we have problem solved, right? And now I have all that data in one place. What I'm really looking for is a decision support system, something to say, hey, here are all the opportunities. These are in your buy box. These are not. Just look at these. I can do that faster and at speed. Maybe I can analyze more deals. I can make less mistakes. I might say something like, well, this one's a little out of range. Maybe it looks pretty, but you really shouldn't do this deal or vice versa. I think that's the direction. And over time, as data gets a little better and a little more ubiquitous, and as the models get a little tighter, slowly, the range of where I need to make a decision will get more narrow. And when it gets really narrow, it's not going to be automated like high frequency trading because it's not a commoditized asset, right? You know this better than I do. Like, no two assets are the same. So we're not going to be like, oh, we're just trading in and out of this asset to that same degree. But it will become like, hey, this is not a cap 6, that's for sure, right? Yeah. And now we just decide if it's cap 5, 5.2, we're in a much smaller range.
Yeah. Well, actually, I think it can be commoditized at some point, but
so what needs to be true for that to be commoditized?
Well, here's the way I think about it. So I remember I was on like a panel, I don't know, a million years ago, and somebody says to me, "Oh, you could never do this with commercial real estate," and the comment was, "Well, you need to walk the building." I'm like, "Really? You need to walk the building?" I'm like, "Well, think about the equities market. You're investing."
I'm not walking Apple.
Exactly. Are you walking Apple? Are you walking a company, right? 2 office buildings are way more similar to each other than 2 different companies. We're both commercial real estate data companies. We're far more different from each other than 2 office buildings are. So if you can find a way to create an efficient market by which you can high frequency trade the equivalent of CompStak and Cherre in public markets, you can do it in real estate. Now, why does it work in the New York Stock Exchange? Because the financials are regulated and they're normalized, and
there's a centralized clearinghouse.
And there's a centralized clearinghouse for it. So I think that like if there is some equivalent of a New York Stock Exchange for commercial real estate and for the assets themselves, then theoretically you could trade
all these
on
tokenization
them.
Platforms we've been shitting on for years are now so happy to hear us talking about this. I'm sure. Right? Yeah.
Well, look, I don't know. I don't think that it needs to be on the blockchain. No, you don't need to be on the blockchain in order to do this. Like that's like a problem searching for a solution, searching for a problem. But the New York Stock Exchange isn't on the blockchain and it works just fine, right?
For now.
But theoretically. I think it certainly can happen, but I think you make a good point about the fact that at the end of the day, identifying the assets is one play, and then actually getting people to transact on them is another one. I remember when I started as a broker, I lived on the Upper West Side, and I walked by this self-storage place on the Upper West Side, Sophia Storage Company, and I'm like, it's the Upper West Side. What is this storage building doing here? Like, this can't be the highest and best use. I'm a commercial real estate broker. I'm going to see if I can do something about this. So I call up Mr. Sophia of Sophia Storage, and I'm like trying to pitch him that I've never sold a building in my life, right? And I'm trying to pitch this guy that he should sell his building. And he's like, "You fucking kid." He's like, "Who are you kidding?" He's like, "You know how many brokers have called me today? Like, everybody calls me."
What was the deal, by the way? Why wasn't it?
He was making a lot of money.
Yeah,
that was
good
the
money
deal.
On storage.
That was the deal. That it turns out that self-storage in Manhattan actually is a really good business. And
I got a unit in the Upper West Side right around that area. Yeah.
And he was doing great. And he didn't want to sell because he was doing well. And maybe it was the highest and best use. And if not the highest and best use, it was certainly a good use
for him.
And it was making lots of income for him. And he didn't want to sell. And it's a good point. Just because you've identified something that you think is an arbitrage, and maybe a model can figure it out, doesn't mean that somebody's going to trade. But I do think that like to your point, like the transparency in data can get us a lot closer. Because when Skyline was getting started, like they didn't have access to a lot of the data. I was on a panel with Guy at one point, and I remember him pitching about how he could create a correlation between property values based off of proximity to parks and number of trees.
Yeah, I remember
number
that
of
tree
trees.
set, damn.
And I'm like, come
Guy,
on.
if you're listening, I'm sorry. It's just too funny.
By
to
the
me.
way, really nice guy and really smart guy.
Really smart guy.
And
that was funny as hell, the tree set.
And I'm just like, I get it, like, sure, but you know what really correlates to the value of a property? The rents. Like you just don't have access to the rent data. But yeah, I think that like I do think we're going to see people who are going to try models that are truly computer driven, truly algorithmic. Whether they work or not, is another ballgame. And you and I, we chatted a bit about this with, what Zillow attempted, trying to apply the Zestimate, right?
Really hard. It's really hard. I mean, Open Door arguably is doing the best job trying to create markets there, and it's really. That's the easiest asset because single homes are a lot easier are a lot less complex than there's no P&L on this thing. It's stupid simple, and it's still hard to do, and it's also hard to acquire, right? So I think about the big SFR operators. They can't buy anything on open market right now because I'll go look at the house and I'll pay more than it makes sense for them in a 7-year hold period, right? Even if I'm a REIT, you can't just overpay. Or I guess they can because they are doing it, but it's harder to overpay. So you can't get a good deal. That's why they're all going into build for rent space because
you could only overpay if the market is perpetually going up, and you have the safety net of the market perpetually going up. And a lot of people looked like they were way smarter than they were because the market kept going up. But as soon as that stops happening,
I think, to your point earlier, though, I think let's pretend for a second that all buildings are LLCs or some type of corporate structure where the shares can be traded, right? So now you have equivalent of a company, right? And each building is a company, so we don't have to say buildings. I could think of a trading, and one would argue that that's what REITs are, but to a certain degree, REITs. You have to trust the management system. They're going to be hopefully there'll be a sector focus. That's what most of the market's asking for right now. We don't have a lot of control over the specific asset. Let's say if that's the case, I would say you're probably right. And there was a centralized clearing place to trade shares of these things. Probably can be a lot more algorithmic, right? If I know the yield, now I'm basically saying I'm betting on secular trends. So now it's we're both looking at Apple and we're saying, what's the likelihood that people buy more iPhones or something like that, which is neither of us necessarily know, but we're going to buy information, what they call alternative data in other worlds, which aren't worlds, just data, right?
Yeah.
And then we'll use that to maybe make a more informed decision. Sure. I would argue, though, that one of the things that I've been playing with in my head, which is, do we need to actually have a connection to the underlying asset, or we can just create betting markets? So let's say, this is my argument with always the tokenization folks.
Fair.
I always ask them hey, do you know what a REIT is? And they go, I don't know what a REIT is. That's usually where that whole tokenization story ends. They've just never heard of REITs.
Right.
Because I always say, I want to invest in markets. Well, I can just create a betting market which says, if Manhattan Class A goes up, you get paid. And so long as there's somebody else on the other side of that transaction, I don't know that I have to, because it's not a security, maybe it doesn't have to be tied to any real asset. I mean, I don't know what the SEC feels about this, but maybe they have a really strong opinion against it. But I think you could argue at least that it could be completely disconnected from the actual asset. And then you can allocate the risk anyway. I want to be long Miami office, but with the exception of Wynwood, or you can probably do something like that if you wanted to build a market like that, like a poly market for every asset or geography. Probably better if it's not in crypto, because then it becomes gambling for idiots. But it's not impossible. Somebody has to really care to do this.
Yeah. No, it makes sense to me. I don't see why not. I mean, effectively, look, in many ways, it seems like the stock market today is gambling, and in many ways
for consumer retail,
and then it's rigged for, it's rigged on one end and gambling on the other end. It's
rigged, but I mean, I would argue that real estate's in the same bucket to a certain degree, right? Because if I think about a stock market, so long as people are procreating, there's more people out there, and therefore money has to go into pension funds. The pension fund has to get allocated to the public market at a certain rate, right? And then they're just going to buy up all those assets on the public market at a certain ratio, whatever that is. And that just creates an engine of more wealth in that public market and more exchange in that. And it's just a risk allocation question. Real estate is sort of similar, right? So those pension funds are going to put some of that wealth in real assets. Some of that real assets will be real estate, and therefore it just funnels through. So arguably that's just as much of a legitimate model, and probably the big pension funds who are drivers of the vast majority of the market probably should be driving the real estate market. They probably are, right? I don't know that retail has a right to exist as an investor. Like, I don't want to be like, I guess I could take the, the First Amendment approach that's part of speech using money. I'm not even sure that's true, but let's pretend for a second it's true. Clearly, it's not true in politics, in my opinion, but that's a different story. I don't know that retail is any good at anything, right? Like, why would a retail investor have any clue? Like, we have way more data. We have way more opportunity. Like, why would they even know what to invest in? So if we think about the commercial market, if it's geared towards like Blackstones and Brookfields and Starwoods and Nuveen's trading with each other, they could probably get an exchange up and running just for their own assets, right? Just to avoid the brokers, right? There's money to be made in just avoiding the clearing and having that centralized in a certain case. I think there's a fear of collective action and antitrust and that kind of, and everybody thinks they're smart in our industry, right? Like, nobody's dumb.
Yeah, and it's interesting, and a lot of these pension funds, for instance, they're investing in REITs, and then they're also investing in the hard assets, right? And
on the debt and the equity side.
Yeah, they're playing every side of the equation. They're already effectively, in some capacity, gambling or at least trading in a more efficient market via the REITs, but then they're directly investing in the hard assets, and they're playing it all different ways.
At least in their world, there's like portfolio theory that would, again, depending on these pension funds, but at least in theory, somebody's sitting there going, well, I'm investing in the entire public market, including REITs, right? So there's some allocation based on that. And if I'm not buying whatever the index is, I'm essentially shorting, or if I'm buying more, I'm long, right? And then I have to have some type of uncorrelated assets. So presumably, again, they're not completely uncorrelated, but portfolio theory would argue that the more asset types I have, the more uncorrelated my portfolio becomes, the more likely to be diverse and distributed. So I have to invest in all those things. I don't know if the methodology makes sense though, right? Because they're investing in the same private equity funds and the same. So I'll invest in real estate through the REIT, through the private equity fund for equity, then through private equity credit. Then I'll also invest directly credit in the assets, and I might buy assets directly. It's hard to, I don't think they actually do the calculation of the overexposure there. They could also be exposed to the insurance at the same time, right? Because they're probably also in the insurance industry. Like, there may be multiple exposure there, like across the board, that they're probably not calculating correctly, but at least in theory, it makes sense from a portfolio theory perspective.
Yeah, interestingly. Yeah, I think, the REITs, I think, tend to move in advance often of the real assets, because they trade on optimism and fear, for what's going to happen in the future more so than the fundamentals, right? I mean, like the net asset values of these REITs do not correlate very well to the
Doesn't
the
that
market
make
caps.
sense though, right? Because in theory, if I'm a smart investor and I wanted to short a physical asset, I can't. I can't buy a physical asset either, usually, right? So, but I can short the REIT or, sell out of the REIT and undervalue. So if I think, this is true, by the way, in the beginning of COVID, right? All those hotel REITs got decimated way before the RevPARs went down.
Exactly.
Right? Yeah, I think it makes sense, at least in theory.
Yeah, it does, although it's...
Yeah, it's not directly correlated.
It's not at all, and sometimes you'll just see a massive discrepancy, and then you see these REITs buying back their shares because they're like, they're saying our assets are worth more than the market says they are. Well, this is ridiculous, and that there should be, I think, some level of correlation. I mean, I think that some of the discrepancy got to be too big, but that's a whole other story. So, what about the relationship side of the equation? Like, as we get more automated in driving these transactions, do the relationships become less important, or or you might argue they become more important? What's your take on that?
I could argue both ways easily. But I think about public markets, the brokers have all but disappeared, right? You either pay them for deal flow, which is like just like a fee, essentially, like a small fee. It's not like a transaction fee. It's not like a big percent. Or if you're doing some big off-market transaction, you're trying to sell a block without the market figuring out. Even that today mostly happens in dark pools. Like, even that's happening in that dark pool will, at the end of the day, like, give you the net. They're not telling you what happened during the day there. And I think that, there are a lot of arguments around why dark pools are bad. But in disclaimer, I worked at Knight, which later became, now it's Virtu Group, right? The biggest market maker in the world, which is probably the biggest dark pools at the time. Maybe today it's Goldman. But I think at the time that the biggest dark pools. Gray pools, we call them, because it sounded less egregious to the regulators. But in many ways, there are advantages to that, because again, if I'm a big company selling a big position, just putting that on the market affects the price, right? Whereas I can trade that block, in a dark pool, and it's not going to affect the price anyway. And at the end of the day, that's going to, clear out. There also might be many reasons I don't want people to know I'm selling. It may affect my, I'm selling a piece of something, but all the rest of my business is great. I don't want the market to know that I'm selling, and because maybe it might create an image problem within that world. So I can think of a lot of reasons why that makes sense. But generally in public equities, the idea of going to a broker and saying, hey, broker, give me access to Apple seems unfathomable to me at this point, right? I might go to a TD Ameritrade or Schwab or something like that and open up an account and they're my broker, but it's really just a facilitation fee or like an operation fee. It's not like a real broker in the sense like a real estate.
Sure.
Because we don't have stories anymore, right? Even banking, right? Investment bankers who are brokers, they just don't like to call themselves that.
100%.
Right? Yeah, they're just investment bankers, right? And their job is to place debt or equity. Let's use the equity, right? And forget startups. I don't tend to not like raising capital in this age. Most of the brokers at our space, like the BCD are the worst. But some are really good. The good investment bankers are like I think of a big bulge, shop. They're either gonna take you public or handle the M&A, right? Why do I need them? Yeah, there's some process stuff, but I really need to tell a story, right? I need them for the relationships. Because in that world, it's not trading on an exchange. You're trying to sell your company into cyberspace. 10 companies. Your VC knows another 10. That's 20. There's 1,000 you can go out to. And you don't know who's buying and what their buy box looks like. So the job of the broker there is, because there's an asymmetry of information, their job is to facilitate that. Now, in real estate, that is the case. There's a massive asymmetry of information. But I can definitely see a world where they're not necessary in the relationship, right? I can see a world where, back to our exchange example, right? If I put, and by the way, if you look at RCM and 10X, what's the other platform they have? 10X, auction.com, and then Crexy's auction.
Yeah.
And you just look at the volume there over time. It's growing every year. Like, again, dipping up and down. But if you just look at it as a general rule, the trend is very, very clear.
Yeah, but most of those auctions involve brokers, though.
Oh yeah, the brokers are putting them up there. Yeah,
Yeah.
I mean, I think all of them are brokers.
Yeah.
That's why I don't know a lot of people without broker, but it's already showing us that those brokers at the low end of the market think that it's easier for them to go and put the asset on RCM than actually going and selling it in the market. And they're willing to pay the whatever fee the broker's taking there. And that tells me at least that if that's a bellwether, the rest of the market maybe put aside large trophy assets or some special whatever, like some complicated distress deal. It tells me that's a direction for the entire market. And in the beginning, just like in the stock exchange, it'll be brokers trading with brokers. Like if you went back to the 70s and 80s, we already had Instinet, right? Nomura and all those systems. People were still trading. Brokers were trading on those electronic platforms. Today they stopped, right? They just trade directly. I think that may be the direction we have where, not in the near term, right? In the near future, relationships are going to be paramount. Even if you have the best data, it's access to the right buyers and sellers, knowing what they want, helping to tell that story, help grease the wheels, because there's a difference between where we want to be. And the buy side, sell side broker they don't get paid unless there's a deal, right? So their incentive is to work with both of us to be flexible. If the data becomes ubiquitous and the asymmetry is gone, then it just becomes a process fee, and then the broker fee keeps going down and down.
Right. And I think, the relationship you honed in on is the broker relationship, but then there's also the nature of the relationships between the principals, right? Because let's assume there is no broker. Now you've got, two bids that are effectively the same from two nameless buyers.
Go to my friend who I golf with, probably.
Right. You're gonna sell to, all things being equal, price being the same, you're going to sell to the person you've got the relationship with because you trust that they're actually going to follow through with the deal, right? They're not going to screw you. So there's some element,
certainty. You're right. That's another part
of wanting the certainty that comes.
I think
with
it's just a certainty. Like, I actually don't care about it if I golf with him. I think it's just a certainty because I think that because I know him, I'm more likely to close the deal. So I think it's a risk question.
Yeah.
But if it's all the same and the risk is all the same, like if I have both of my friends, I'm just going to say to them, hey guys, make whoever gives the highest bid, right? I don't care.
Yeah. I think
loyalty ends pretty quickly in our industry, I feel. Wow.
Unless, of course, I think if you're a large enough player and there's many more deals to come in the future, then yes,
there are a lot of repeat players.
Then it won't just be about the certainty of that deal. It's about the certainty of future deals, I think, as well.
Yeah, it's definitely true in the debt space in our industry where, the debt players are all repeat players. They much rather have certainty around the transaction, certainty around the payment back. I look at like Xtel, I don't know if they've ever returned money to their equity players, right? but their debt players always get their money back. And I'm sure they made some, I'm sure I'm exaggerating the equity side, but like I look at all those buildings, like when I look at like the Nordstrom Tower, that's like the symbol of an end of a bubble. Like that literally, that's, if they needed like, what's the trophy of an end of a bubble, that's what it looks like. And he's clearly incredibly good at building. I mean, I look at some of the projects he has coming right now. If I had to guess, he never defaults on his debt. If I had to guess, not all of his equity holders killed it.
Right.
I'm sure some projects were amazing, some that, but like, I'm pretty sure his debt players killed it every time. And I think that's where the repeat process happens, where your point where I'll go with somebody who I know that Gary's going to give me my money back. I know he's not going to screw me, right? The equity, you're taking a risk. It is what it is. Like, nobody's angry if well, maybe you are, but it doesn't matter. No one's going to care if your project didn't work out. It didn't work out.
Right. Fair enough. So I know, so I think it'd be interesting to go beyond AI in real estate, talk about AI a little more broadly, because you and I are both kind of tapped into the tech ecosystem a little more broadly. And so I know that I see either founders I know or founders that I know kind of tangentially, and I see funding announcements, on LinkedIn or Twitter or what have you, and startups that either I've invested in or people who I know have invested in, and we're just seeing growth rates in AI right now that are just out of this world, right? Like companies are growing faster than any companies have ever grown in the history of time, or so it would seem.
Yeah, emphasis on the so it seem, I think. I'm not sure if that's all true.
Fair. I mean, I believe that probably a lot of it's true. I also believe that that they can blow up just as quickly as they took off, because if you can build anything that fast, somebody else could probably build it that fast too. I mean, it seems like, but we could talk about that. But I'm also curious, have you seen anything that looks like that in our space? Like, do you think that there can an industry vertical even support a company that can grow that fast? Is that even a reasonable expectation?
Well, we don't have enough data yet, so I don't have an answer. I think it's a bit bipolar, right? I look at the very large, like OpenAI kind of companies where massive growth, like those are the fastest growing companies, the biggest. I mean, I don't know the data. I know that like Deal was like one of the fastest to reach 100 million, and then Wiz was even faster,
right.
Just sold for 32 billion. I think Deal somewhere at that like 12 to 15 billion, if I remember correctly, somewhere in that ballpark. Like that was really fast growth in classic SaaS, enterprise SaaS.
Right.
And I mean, so they also have like SMB, I guess, but still classic SaaS. Those are still the biggest moneymakers overall. Like SaaS is still a bigger industry. AI is part of the hype cycle, and I don't know, XAI is valued at 80 billion. As far as I know, there is no revenue. I mean, I'm sure there's some, but like it's got to be abysmal. I mean, I think the reason they just bought X is because that's all the people who use Grok is X. Like I don't think anybody uses their platform. They don't really. I think as far as I understand, the new model doesn't even have an API. Like it's literally impossible to use in business.
I mean, that's also the epitome of conflict of interest. I mean, there's no.
Oh yeah, for sure. Yeah, he's done that.
What's
before.
the opposite of an arm's length transaction?
He did
whatever
that
was. I mean,
he bought Solar City into Tesla.
I mean, it's
and there's like this energy. There is this like the energy business in Tesla. And people will always say, "Well, isn't Tesla?" No, it's not even the same energy business. Everything from Solar City shut down. Nobody buying those panels. And there were lawsuits, but Chancery Court found that it's within. I mean, they don't do valuation. They said it's within reason. Yeah. These are both public companies? Figure it out, like but without saying, hey, does he actually control that board completely? Yeah, he does. Right? But yeah, that's. I always have a love-hate relationship with Elon. Like on the one hand, like he's an incredible creator of equity value, and clearly has some interesting ideas, even if they're not his unique, novel ideas. He's able to deliver. Like SpaceX is pretty incredible, right? Even Tesla, right, where it's like. Yeah, there were Detroit Electric existed 150 years or whatever, something year. The first electric cars. Like, we're talking about like more than 100 years ago, but clearly he's been able to do some execution. And I'm sure he's taking credit for a lot of people. That's fine. But the flip side is also like, hey, it's a whack job, right? Clearly. I mean, he's got more kids than he knows, right? At any given point. You just have open Twitter to find out how many kids he has. He doesn't, I mean, literally, I just saw a battle of him and one of his baby mamas on another kid that he's just found out he has. Like, it's crazy to me. Those companies generally are kind of the foundational models. It's not a big group. It's a small company. I just saw like OpenAI is like more than like the top 5 private companies, including Databricks, combined in valuation. And XAI is in that top 5. They're at 80 billion. Databricks needs to go public, clearly. It's just a question of valuation. But then if I look at all these smaller companies, it used to be the case, and I'm sure some seed investor will call me out that I'm not exactly accurate, but it used to be like 12 to 18 months to get to $1 million. That's the expectation. And that was a signal that, a round A investor or late seed, like our institutional seed would say, hey, did you get to about $1 million in kind of 12 to 18 months?
Sure.
If the answer is yes, awesome. We'll fund the next round. And then you have to triple, double, or something along those lines. Right?
Yeah.
And then we get to our size, like, are you still growing high double digits? Oh, amazing, right? Once you get to low double digits or single digits, you're done. Basically, it's like sell or profitable, right? And usually it's profitable at this point, but not a lot of companies can go profitable also, right? I invested in a company called Unity, right? Shout out to Francisco. They managed to get to, $500,000 to $1 million in like 7-8 months, right? And today, I think on average, you can get to $1 million in like 8 to 12 months. I think like 9-10 months is the median. So the time to get to that $1 million is shorter. Now again, inflation, but still not that much, not the equivalent of 6 to 12 months of inflation, right? So yes, that's the case. I get that, but does that pace continue? I don't know. And is the quality of the revenue such that, like, it's easy to win?
Quality of revenue as a whole, yeah.
Like, are they growing these clients, right? If I'm an A investor and I look at something that was funded at a seed, like a 3-4 million seed round, which is very common these days, company reached $1 million, maybe even bootstrapped today, right? And I'm saying, okay, do I want to invest in this? My first question, what you already pointed to, is like, hey, if you got there this fast, what possibly could you be doing that I can't do on my own? And the answer usually is nothing. They're just the first mover, right? Again, I'm not trying to shit on that, but like, it's not a defendable kind of thing. So then I'll be saying, I'll be looking at things like, are you able to increase revenue within a client? And then I'll look at, is the net retention growing? Is the churn ratio and the gross retention, high? I mean, a lot of people signing up and trying and then disappearing. Of those that signed up, are you able to upsell something? That's a good signal. If you're able to upsell, you're adding enough value that I want to grow my footprint with you, even though there are other options out there. Even though there are 15 other competing tools that probably popped up in the last 18 months, I don't want to try the other one. I want to grow with you. So I think those signals would be good.
The competition is the key thing. Personally, I think that you could build a product and that's great, and that does upsell and that does have good retention and that everything is looking great for it. And then somebody else comes along and just builds one that's a little bit better, right? I mean,
it's pretty. We're all using the same model. It's pretty commoditized,
right?
But can't you argue about that with any company? Like,
of course you can, and I always hate that argument. Like when people would, in our space, right? People are like, well, why doesn't CoStar just do what you're doing?
Right,
and it's
like, they don't.
because they don't, and because if you could ask that about literally any company in any space, except. I don't want to sound ridiculous saying it now myself, but the reality is that like. Everything is just moving at a different speed now with these AI foundational tools. I mean, and the way that people are building things, people literally are spinning up new companies in days, and like it just feels like more of a fundamental risk.
I can copy those features like instantly,
and
I have the distribution channel, right? Yeah.
It feels like a much more real risk. In this particular case, than whereas I would have told most entrepreneurs to disregard that kind of comment, in the past.
I always joke on enterprise SaaS that it's the easiest business in the world. You go to a client, say, "Hey, would you pay for this?" "Oh yeah, I would." "How much?" "Great." "And if I get that done in 6 months, is that good?" "Yeah." I don't have to be smart to answer. I just have to ask those 3 questions and have a relationship with someone who's willing to take that bet on you. In an enterprise SaaS, you know this well. Especially we pull in client data, convincing an enterprise client to give a startup access to their data, that's hard.
Oh yeah.
That's not a foundational model. That's some founder willing shit into existence against all odds when it doesn't make any sense that it should even be allowed, right? And if I looked at those same AI-driven companies, I think I would ask the same question. I don't care what tool you're using. You can be building a SaaS. I don't care what it is. I would ask the question, which is, are you able to create some kind of defensible model that is not driven by whatever, like, it's not the question of, do I have this model by OpenAI or by someone else? Is the business model at its core something that's defensible? And I don't know, I mean, again, back to Unity, I had this exact question. Elise is an incredible company, Elise AI. Minna shout out to Minna, one of the best operators out there. Like, I'm not going to say how much revenue she has, but she's killing it, right? And I think she's one of like the most undervalued founders out there right now, right? And because she's like soft-spoken, but she's a killer, and like she runs that business tight. And the first question I literally said like to friends, like, hey, you're competing against that. Like, she's a killer, and her team's a killer. Her husband's a CTO, rockstar. Like, why would you succeed? He goes, well, first of all, I'm going into spaces they're not in. She's already a good, interesting style. Like, well, why are they not there? Well, you know, they did something in this space, and they moved into healthcare, and they've clearly left these parts alone. And we're going to take those parts. They're really valuable. And then maybe in the future we'll compete with their core market. But we have all these other parts of the market that she's not touching right now on her team. May or may not be true, may or may not be successful. It's a separate part. But I would try and think about the analysis similarly to the way I would think about a SaaS company, which is I don't care what tool you're using. I don't ask you if you're on GCP or Azure. I don't care, right? I would ask, what is the core business model, and why is it defendable or defensible, and what about this industry makes it work? And if you can answer, hey, I have the relationships to get me in, or I have a unique understanding of this industry that other people don't have, or I have the ability to build a suite of solutions for clients that solve their problem, I almost don't care what the tool you're using to solve that. Now, I might say, hey, listen, if that answer you just gave me sounded really simplistic, I might say, yeah, well, it's bullshit, right? But I would say the same thing in SaaS as well.
Yeah. So you mentioned you could build, you know, some of these things as features. Let's say that somebody else is rolling out a company for. I think that, you know, some of our customers are thinking the same thing around AI. Are they right or are they wrong? Like, to what extent should our customers be thinking that they can be rolling out this technology on their own versus working with us, working with somebody else, working with a dedicated AI consultant of some sort?
What's the biggest CTO office you know in our industry? Maybe Blackstone?
Maybe Blackstone, yeah.
Maybe Brookfield after that. These are tiny teams. Talented people. They're really small teams. They can augment that with, you know, staff that they hire, you know, ad hoc, or like these consulting kind of services, but they're tiny teams. And the list of shit they have to do is endless. Like, their backlog is years long, not months long. So the thought of them being pioneers in pushing new stuff out is unfathomable to me, candidly.
What about the brokerage firms?
You get me in trouble here with our clients, right?
Well, because some of them actually have some pretty big teams.
Yeah, in India doing data entry for half the world, right? Building some or maintaining some 90s Windows system. I don't need to tell you what they look like, right? I don't want to name names, like these are all our clients, but you know, I would say JLL probably has the biggest tech team right now, and Yao is smart. Like, she's a really smart person, and Oren Israel runs that team. He's really smart. He's, again, from previously the Skyline team. Ishai now left, but you know, those folks are smart.
Yeah. And
they have a giant tech team. And my opinion, and I'm sure that they hate me for saying this, is they haven't had these massive successes internally in-house. I think one of the reasons Guy left is because, you know, he was put in charge of managing all these legacy systems that like are not exciting as a founder. Is used to being cutting edge. Like, I got to maintain these 20, 30-year-old systems and I have to integrate them. Oh, my God. It's like a depressing thought, right? Sorry. But of course he went to Melio because it's a cool startup and he grows and gets to run product. It's a really cool company, right? So I don't know. It's hard for me to think about them being successful in that. They have enough challenges on their own. The smart ones, I think, would have a good strategy, though, of saying, you know, what should I be doing to be able to capture the advantage here? I think most of the time, my recommendation to companies would be, don't do anything. Like, whoever your service providers are, ask them what they're doing in the space. Like, you're adding tools, right? Like, we're adding, like, your client, your vendors are going to be doing these things because to serve you. And if they're not, fuck them. To get rid of those vendors, tell them they suck and they have to be, you know, much better to earn your business. And if there's a small startup that competes with an existing vendor you have, go try the startup, right? Trial a new system. Like, hey, you have somebody you have a new version of, you know, lease management, fine, I'll pilot anything. What do I care? And try and do that. Building in-house, it's back to the innovator's dilemma and back to, you know, people doing what they do best. Are you as an organization a software development company, or are you an investor? And the answer is you're an investor. Your job is to wake up every morning and say, which markets are most exciting? Which sub-markets are most exciting? which assets are the like all the things that we've been talking about, like that really changed the industry, right, on a day-to-day basis. If you're on the asset management side, all you care about is what do I own, where do I own it, performance. If you're a lease manager, I just want to close space. Like you're way more tactical, and you should focus on those things because that's what you're best at. And if you're not, get out of the industry, like 'cause you're not really going to make money if you're not good at these core things, right? And whatever you're not good at, you should be outsourcing already. Like there's a reason Brookfield moved their office and management. They talked about it recently, into CBRE because CBRE is really good at property management for office, right? I don't know if globally, whatever, but within this market, they're really good at it. And Brookfield wasn't bad at it. They were good, but they said, well, we have a million things to do. We're really good at allocating capital. We're just one of the best in the world at that. Do we also need to be the best in the world at managing every asset everywhere with all the complexity when we're only managing our assets and CBRE is managing it for everyone? No, let's give it to them. We'll get a better deal financially. We'll probably have a better service overall because these people do it better if we can hold them accountable. And we're going to do what we do best. Now, all those resources are allocated to something which is better. So same thing could be in technology. Are you the best at this? There's no way you're the best at this. Like this is a cutting edge thing that even really good technology firms are struggling daily with brand new tools. Like we have to struggle. Like we're adding Cursor, you're adding WinState. Like you're adding a new tool every month at this point. It's cutting edge. And you think a firm that has like 3 engineers can do that? It doesn't make sense to me. It's hard for me to imagine how that could work.
Yeah, fair point. Although I do think what's interesting right now is like to your point, adding these tools every day. It's like it's hard to keep up. It's it's hard for us to keep up. It's it seems like the only good news is when you don't keep up on one thing, it's like you have an opportunity the next month to try to skip it and do the next best thing that maybe that was more efficient than having tried the previous thing to begin with. That's the
we test a lot, roll out less. Like we're just now piloting Cursor, although we've been playing with it for a while, certain people on the team, but we're just now actually piloting it and hopefully roll it out, see if it works. We do have GitHub Copilot, but we definitely use that. Maybe 20-25% efficiency gain, but Cursor has the promise of doubling output potentially, right? We'll see how that works. It's still the jury's out, but I would say that our philosophy has been to test everything, get a sense of potential, right? We've been testing a lot of fun tools, but actually adopting, we're a lot more cautious.
Well, I think you make a good point on tools like Cursor, or GitHub Copilot. These are tools that are really powerful in the hands of people who actually know what they're doing.
Yeah.
And
really dangerous in the hands of a young engineer.
Exactly.
Terrifying.
Right. So people who know what they're doing know when these things make mistakes and know when they can save them time and know when they can't. And I think you can draw, an interesting corollary because that's the case with a lot of these tools, right? Like you have an analyst ask ChatGPT to build a DCF for them and it'll screw something up and they won't know necessarily if they're brand new analysts versus somebody who's built models before.
Tools for analysts generally is a bad market.
Well, right. So let's talk about that, right? Because theoretically, you could argue if my analyst is just going to give shit to ChatGPT, I don't need the analyst to do that. And I don't necessarily need the analyst to build it by hand either.
I don't need him at all.
Why don't I just do it myself? As a mid-level person and a real estate investor, and with the help of whatever AI tool, and cut out the analyst.
I can make the argument of the death of the junior for sure. In decision support systems, as we talked about earlier, like DSSs always lean up to the most senior people, and in our industry, like contrary to maybe what people outside the industry believe, decisions are made very top of the pyramid, right? Even if there's an investment committee, which there usually is, especially in an institutional fund, they're often like, monkey trials, right? It's like there's one person who really runs that, either that deal or that sector or whatever. Everyone else will ask questions, but nobody's going to override that. Like, I don't know, again, not to name names, but most of these funds are like 1-man shows up to 5-man shows, right? And it's mostly men, by the way, jokes aside. And they're not very diverse in opinion or thought, and most decisions are made, and nobody ever tests them, right? I'll make the investment, and then we'll wait 2 years for the asset to stabilize, and then you'll benchmark versus. No one ever goes and benchmarks my investments, really. The market went up. Everybody, nobody. Like it's hard to answer some of these questions. So, tools for those people seem more valuable to me than tools for analysts, especially because they can say, "Hey, this is helping me. It's giving me good advice." I think what we're getting with this agentic world is a much more a world that's much closer to getting a virtual MD, not a virtual analyst, where I can wake up and say, "Hey, MD, I'm about to do this transaction. Here's all the data, that came out. What am I missing? Oh, have you looked at that? Yeah, that's an interesting question. The type of questions you would get in an IC, right, that would ask. And
well, why do you say that? Because you just said you think it could be the death of the analyst, but then you're saying you think it's not going to replace the analyst, it's going to replace the MD, or maybe
not replace.
Or you think there's not going to be a virtual analyst, there will be a virtual MD.
I think there'll be a virtual MD that I use as an MD.
But there still will be an analyst.
I don't know. Maybe the analyst is gone.
Yeah.
Maybe the analyst is still there to do all the process stuff that requires a human, and that might change over time, right? Because today they're building a DCF model, tomorrow they're doing something else. I think there are a lot of tasks that still need to happen.
But that probably means there's fewer analysts.
Probably.
But all these MDs, whether let's not the virtual ones, the real ones, all these MDs, they started off as analysts.
Yeah, how do we get new MDs?
Yeah.
You'll have less of them because you probably don't need as much, right? If I replace my IC with 5 really good MDs, virtual MDs, who really know the industry well because they're given all the data. It's more than I'll know. It's more than you'll know, right? So they're all by definition going to be at least as smart as I am or better. Those are the people I want to give me advice, right? I don't want to ask the analyst. What is the analyst going to answer me, right? I want this person to say, "Hey, MD, you're about to sign this asset. Like, your assumptions here don't make sense."
So if there's fewer analysts, there's fewer MDs, there's fewer people doing real estate investments. Whenever there's any new technology, people bemoan the jobs that are going to go away because of
old jobs going, but there's always new ones.
There's always new ones. What are the new ones?
I don't know. It's something I've been trying to think about as you're asking this question.
Because there's always new ones.
I don't know the answer here. I know a lot of jobs have been created around, tagging, for example, right? Just for classifiers, things like that. I mean, that's on the low end menial kind of jobs. I think we're creating a lot of jobs like that. I don't know the answer to that. It's an interesting question, but I know that they'll be created. That's what I know for sure.
I 100% agree with you because they always do, but you never.
Because we'll have brand new industries. I think whole new industries didn't exist. Maybe in real estate we'll have less analysts. But you'll have a whole new industry of I can't even think of it because if I was smart enough to think about it, I'd probably be investing in those companies. But again, short horses, right? Which car specifically is going to be successful? I don't know, but I'm definitely shorting horses. I'm shorting analysts, right? I know that the analysts their value is going down because they don't provide any information. Again, assuming we're not talking about a people-heavy industry. Like if I need people cold calling and people, even that probably voice chats are going to be pretty good in a second to replace some of that. I've seen some of the voice agents. They're getting really, really good. So let's assume that a multimodal model within the next 2 to 3 years replaces human and that stuff as well. I don't need all those analysts. They're going to disappear. And I won't need as many MDs as well. And we'll see a lot of single MD funds that can do everything alone.
I've been wondering a bit about the future of more of real estate education, because it's really been a vocation, right? Real estate as an industry, yes, there's masters in real estate programs, but largely people learn
nobody studies at a master's program.
People learn real estate for the most part on the job. But is that going to change? Are people going to be? Is it going to be a prerequisite?
I don't know. Maybe
you have to have a master's in real estate to get into to get a real estate.
I could
job.
argue that the master's actually becomes more valuable because those master programs don't teach you the skill, although a lot of them are very hands-on. They teach you how to think.
But even if they do teach you the skill, maybe it's a skill you otherwise would learn in the analyst job that you can't learn in the analyst job. So now you're
it doesn't exist anymore.
So now you're expected to know it coming in.
It's a good point.
So that, right.
Yeah, maybe that's what happens. Maybe the gatekeepers become higher. Yeah, I mean it's true for all degrees.
Or maybe maybe you invest in some for-profit equivalent of these masters in real estate. I don't know. It'd be.
So we send some of our folks to Brad's program. I don't know if you send anyone there. It's Brad Hargreaves. He has a good CRE school. Mm. So if I have some of our employees hardcore industry people.
Oh yeah, we've thought about doing something like that.
So again, plugging. I have nothing. Unfortunately, Brad's not giving me any money to do this, but maybe we should work it out. But those folks that we sent there didn't come from a real estate background. And we even sent 1 or 2 people there that have been at Cherre for a few years, at least know. They came back with really good feedback. We learned a lot about the industry here generally. So I like that program generally. Maybe programs like that become a lot more valuable because they'll teach you skills that otherwise the analysts won't learn on the job anymore.
Sure.
Yeah.
Yeah.
It's an open question.
Cool. So we're almost out of time. What do you think is going to be a key driver for competitive advantage in AI?
I think the biggest challenge is where to focus. If I look at where a lot of tools have been focused today, they've been focused around document extraction, automation, which again, I'm not belittling that. It's very valuable. Like, some of our peers, have a lot of value in doing that, right? I think about, let's say DealPath, DealCloud, Altrio, right? Without that, those companies would have to spend tons of money on humans to do stuff. And this has, really created opportunities for them of, pulling in documents, pulling in OMs and broker teasers and generating, it's very valuable to them. Lease abstraction tools, what Leverton spent a shit ton of money back in the day to do is now a lot easier to do. I'm sure that they're doing something new today. That part of the industry is just not exciting to me. It's not very interesting, right? Yeah, it does its thing, but it's not super exciting. I think the more exciting things are what processes can be completely automated. The process of leasing seems to be one, like finding a lease, closing a lease. Maybe you want to walk the space, but I need one person to walk you the space. Even that could probably be self-tour. Like Open Door has like a lockbox, a virtual tour. Like I don't even need, what do I need the broker there to come tell me a story? Again, that's probably the only reason I want the broker there to kind of tell me, hey, I know it looks like shit, but it could be really nice. Like, so maybe I don't know what the TI is going to do, but those tools I think are far less exciting. I think the tools that get more exciting are tools that kind of either automate processes completely, take them out of the way, like completely replace leasing, or completely replace like a quarterly review of assets, or completely automate risk, or things that are more programmatic. Like I think about debt underwriting. Man, that should be pretty auto. And we have a couple clients like, Capital One, like who's like they're pretty close.
It's funny you say that. In the last week, we had 3 different inbound requests
for that
from tech startups that were requesting access to our data to build loan underwriting tools. Like
it makes sense to me because think how simple
3 of them in 1 week.
It's a box, right?
Actually, one was more established company tried to spin off a tool, and then 2 of them were
like I need one of like CoStar Reese, RCA. I need one of like the public data vendors. I have to have CompStak. I need like if I'm in multifamily, I'll need like one of the lease data, right? So the list is not long of the data sets I need to figure out, is this in my box or not? And because it's not like the underwriter is doing some fancy. It's going to Fannie, Freddie anyway. It's going to check. Great. I buy it, warehouse it for half a second until I sell it and package it, right? So that feels like that should be completely automated to me. Same thing with insurance underwriting. P&C insurance underwriting feels to me should be completely automated. The only thing that you might want to keep a human involved in is like the appraisal, but not for the money part, for the inspection part, right? Because the appraisal is worthless, right? Because what do? They literally go and find 3 bullshit comps and give you, what are you looking for? Yeah, well, we're getting the ballpark, right? And if I didn't like that one, I'll go to another appraisal until I get the one I like, right? The inspection, I want to make sure that like what I was told is real and nobody lied to me. Oh, the asset's actually there, right? Or something like that, because Fannie and Freddie. But even Fannie and Freddie will tell you, under a certain value, they don't even require inspections anymore, right? So it tells me that process should be completely automated. Most asset management should be completely automated. Huge parts of investment management could be completely automated up until the last final decision. Even it should tell you, based on everything that you told me, right? You made certain assumptions based on all the information you have in-house, based on all the information you acquired. This is the most likely outcome. And you decide what your risk appetite is. If it's if it's a 2 sigma event, you might say, hey, this doesn't make any sense. This is going to happen. Or if you're in the range, the model ended. Now our judgment should begin.
Yeah. Well, I'm with you on most of that. And I certainly also on the valuation side, like, the average appraiser is like in their 60s. Like every appraiser is either retiring or dying. The industry can't keep up, with the demand. There needs to be more automation in the process for it to make any sense.
100%.
But at the end of the day, it all needs data, right, to make it happen. Like
it makes it work for us.
It makes it work for us. I mean, so we feel
it's a good trend for us.
We're in a pretty good spot because we've got the data to make it happen, regardless of where it goes. So This has been a lot of fun. Really appreciate
Likewise.
it. And
How much bullshit was this conversation versus others? You think?
150% bullshit.
Yeah, pretty much. Good.
Which makes
we
it, I think,
delivered on our promise. At least.
Yeah, totally did.
Okay.
Totally did. So hopefully everybody enjoyed it. And you should follow us. I'm looking directly at the camera to all of you. This is a not podcast, but despite that, you can follow us on podcasting platforms like Spotify and Apple Podcasts.
Fancy.
As well as social media and LinkedIn and Twitter and Facebook. Does anybody use Facebook anymore? Maybe Instagram.
My mother.
Probably not Snapchat. I don't think we do a lot on Snapchat. I wouldn't bother with that. But like, comment, and subscribe.
Ooh, like, comment, and subscribe.
All right. Thank you very much.